Hi, good afternoon, everybody. Thank you for joining us and on another Rocket Dollar webinar. Today we have Ryan Beatty. He's from 1031 Smart. My name is Nick Gonzaga with the sales team. Before we get started, just want to say thank you very much for joining us. We like to offer these webinars so investors have information that they can easily access, whether it's about different investments they can get into or just self-directed retirement questions in general. It is really not a well-known segment of the financial industry. So if you know anybody who's interested, be sure to share this information with them. We'd be very grateful for it. Ryan, why don't you go ahead and introduce yourself? We know you very well from a few years back, so tell us a little bit about you.
Yeah. So before we get started, my company's 1031 Smart. And that's because when I started it, all I was going to do were 1031 exchanges for people, just help them identify properties to do 1031 exchanges into. Over time, enough people reached out and said, we'd like to just invest regular cash or self-directed IRA funds, things like that. And so the name's a little bit outdated. I'm not sure if I'm going to change the name or not. I'm considering it, but I'm not sure. Anyway, my experience in this kind of like passive investing space goes back about 4 years now and covers things like multifamily and self-storage and Bitcoin mining and assisted living, obviously, some debt funds, as well as pre-IPO stocks. And one of the things that I noticed in investing and raising money for all of these different asset classes was that assisted living seemed to be really the most stable and consistent and predictable. And so over the last 6 months or so, I've narrowed my focus down a little bit more into these things that I feel are recession resistant, more so than others. And assisted living is a space that I just understand really well. You can look at the metrics and say, this makes sense, versus some other things. I have a harder time kind of parsing through pro formas and things like that. But I also used to be in the home care industry. And so very familiar with this kind of like segment of the market, and really excited to have partnered with somebody who's an expert on the development side and on the operational side, because assisted living is a heavier operational lift than, multifamily or self-storage or things like that.
Great. Excellent. Thanks. Do you have some slides we can put up there and we'll start jumping into seeing what the opportunity looks like?
I do. All right. Can we see that?
We can see it.
Awesome. Okay. So this is going to be a construction ground up development project in Rowlett, Texas, which is outside of Dallas, with a partner that I've worked with on probably 9 other investment opportunities in the last 3 years now. And, I'll continue working with him because I've just seen his track record has been exactly as advertised. And so he's been a great partner, both for me and my investors, and then other people who also work with him in kind of a similar type of capacity. The construction side is called Build Senior Living, and they build senior living. And then once construction is complete, Hampton Manor, which is his operating arm, kind of takes over. So very much vertically integrated. We are now in Michigan, in Virginia, in Florida, in Missouri, Illinois, and then obviously Texas here. All right, so there's my partner. That's Shahid. He's been the CEO of Hampton Manor and Build Senior Living for the last 13 years. And so today we're going to talk about the terms of this investment, why assisted living is an asset class to consider, why we picked Rowlett, Texas to build assisted living community in, some comparable projects that we've done in the past, some sample interior and exterior photos, just quickly go over the floor plans, and then we'll talk about the track record and the operator himself, and we'll have plenty of time to answer questions.
Excellent.
All right, so the terms, this is pretty simple. So a lot of times when you look at syndicated deals like this, you'll see kind of like a pref return and then a waterfall over that and things like that, and then fees and all that. Here, we're just looking at a fixed return. It's 21% annualized. It's all paid at the conclusion of the roughly 24-month term. So what we're looking at is a 1.42x equity multiple over a 2-year term. Now, it's possible that it does run a little bit over. So the construction process usually takes about 18 months, and construction's already underway. We started back in May. So the construction process usually takes about 18 months. and then stabilization and refi takes another 6 to 10 months, somewhere in there. So we're looking at a 24 to 28 month term where you'll get your money back, plus your 21% annualized return. And before we go on, a common question I get is like, what happens if it goes 36 months? You continue accruing that 21% annualized return. It's not like it's stopping at 1.42 x multiple.
That's good to know.
All right. And just to be super clear, because a lot of times people say, well, am I getting quarterly distributions with this? Very clear here. There's not any quarterly distributions. All the distributions are paid at the end of the term. So you get your initial capital back plus your 21% annualized at the end of year 2, roughly. On the capital stack, a lot of people have asked me, what is the sponsor's capital involved in this deal? And so there you see the thin blue line there. $2 million of Shahid and the Hampton Manor and Build Senior Living's own capital is in this project. There's an $8 million construction loan on this, and then $8 million of LP capital. So far, we've raised $7 million. And so Shahid's business model is to acquire the land, get it permitted, and then break ground with his own money. And then once he's broken ground and started that whole process, then investor capital comes in. And so in doing it this way, it somewhat de-risks the project. To get the permitting process for assisted living can be pretty lengthy. And so it's not uncommon that it takes 2 years to get permitted to even start construction on these projects. And so it feels like feels like your capital is not being used effectively if it's just sitting there while we're going through a permitting process. And so that's why this is our business model, to get it started and de-risk it to the extent that we can and reduce kind of extending those timelines out. All right. So again, project timeline, we've acquired the land. We broke ground back on May 10th. Some investors have already come in June. July is fine as well. I think we'll be done by like middle of July on this one. January 2025, we would anticipate construction to be finished. And then sometime around May or September 2025 is when you'll get your capital plus returns returned to you. Now we will be sending out quarterly distributions on this, and it'll have updates on, how far along in the process we are with everything, as well as drone footage. And I can show you an example of drone footage here in a couple slides. All right. So why assisted living? These are the slides that I really like, because I think, people send their loved ones to these communities and they don't really realize what a business this is, what a thriving business model this is, especially where we are right now. So as you see in this red cone, we're right here. And so in the past, there might have been a slight surplus in the number of assisted living beds available out across the country. But what we're looking at right here and going forward is a massive supply shortage. And so even with more and more of these development deals being done, we're not even close to the equilibrium that the market demands. And we'll get into some of the reasons why the market has such a demand for these assisted living communities here in a minute. So why assisted living? And this is a slide that really, I sunk my teeth into when I started learning a lot about assisted living. First, really, really wide margins. So what we're looking at is tenants paying about 4 times what they pay at a multifamily property. But our operating costs are only about 2.5 times that. So really, really strong margins. It's an uncorrelated investment. This is a needs-based space. For somebody to move into this community, they have to demonstrate that they have 2 years of liquid assets to cover the rent every month. And so we don't really deal with delinquencies or economic vacancies or things like that, because they have to prove that they have the money before they can move in. We don't rely on government payers or anything like that. And that's, this is an interesting class. So there's a few different classes of kind of this like assisted living space. The one that really struggled during COVID was skilled nursing, which is a different level of care than independent living and assisted living. Skilled nursing had a hard time during COVID. We fortunately saw people catching COVID in our communities, but there was no massive outbreaks. There was no massive occupancy falls. One of the things we did see, however, was that people weren't moving their loved ones into the communities as much as they typically would have in the past. And once COVID cleared up and once the vaccines became readily available, there was this massive surplus of people moving into these communities that were obviously just waiting to move into these communities until COVID cleared up a little bit. I talked on that last slide about this supply shortage in assisted living. And up here on the top right, you see 10,000 people are turning 65 every single day, 10,000 people turning 65. And this is going to continue through 2055. So it's not slowing down. This silver tsunami is not going anywhere. And so we're doing the best we can to address that. And we're building probably about 6 to 8 of these communities every year. And we're very thorough with how we select these markets that we build in the deal room. We've got a 30-page market study on Rowlett and why we selected this market. If you're having a hard time going to sleep, I would recommend checking it out. It's 30 pages of stats and data, and there's some good stuff in there, but it's a little dense. There's also limited construction in this space, and one of the reasons is COVID interrupted a lot of the new construction, but the other reason is that permitting process that I mentioned earlier. 2 years from the time you purchase land until you can actually break ground on average, it keeps out a lot of smaller operators from building new communities. And then really, really sticky tenants in this space. The average length of stay is 24 months in these communities. And this is typically the last place that folks go to live. With the way we build these communities, there's a continuum of care where there's typically independent living units and then assisted living units and then memory care units. And so there's really no need for somebody to move out, until they reach kind of the conclusion.
Thanks, Ryan. That's so much information. So when it says 10,000 turning 65 every day, I mean, we could look at that and think, oh, with advancements in medical care and technology, that even if they're turning 65, I mean, they could live until their 80s or 90s or even longer.
Sure.
As we get these advancements, right? And the whole silver tsunami and the boomer generation, they're obviously going to need places to be. And the older, I guess, senior assisted living facilities, just how much better are they now versus what they currently look like?
Yeah, so there's some huge differences between the communities that were built maybe 10 years ago and communities like this. And so, 5-10 years ago, we saw a lot of these communities that were multiple stories, which was fine, I suppose. But the other thing we saw is the activities weren't necessarily very robust for the seniors. They would get lunch and dinner served to them and, maybe have some activities like bingo inside, and that's about it. What we're seeing at these communities is that, especially because we have independent and assisted living at most of these communities, people are moving in well before they need hands-on care every day. And so in addition to activities like, I was just on the LinkedIn page for one of these Hampton Manor communities, and they took the seniors to a minor league baseball game yesterday. It's not uncommon that they're going to breweries, they're going to malls, they're getting out quite a bit. Each of these communities has its own shuttle bus to take them around. And the other differences are mostly on the construction side, and that's that these are all one-story buildings. And so there's no need for stairs, there's no need to rely on elevators. Everybody lives on the same floor. And we find that the seniors really like having just kind of a one-story setup. I know my parents, they're only 65, but they moved into a one-story building. So that's, pretty common with what we see now.
Right. My parents too. We did get a question rolling in. Thank you, Chris. And it was just a question, is this part of a portfolio of projects, or this would be one particular investment? And it looks like it would be one specific investment.
It is one specific investment. And so Shahid from Hampton Manor Build Senior Living, his business model is to build these communities, refinance and return investors' initial capital plus the returns, and then he owns them himself in cash flows. And his kind of like long-term business plan is to, in 10 to 12 years, sell the entire portfolio off to a REIT, have a large exit, kind of sail off into the sunset. But this is just an individual property that we're investing in today or talking about.
So it's project by project, really.
Correct.
Okay, thanks.
It is like on occasion, if the projects are really similar, like last year I worked with him on 3 construction projects, all in this kind of like same area in Missouri. There was no difference. The timelines were all the same. And so it was a portfolio of 3 projects, but this one is just an individual project.
All right, thanks.
Mhm. All right. So for those of you who aren't familiar with Rowlett, Texas, it's right outside of Dallas. There you can see kind of a picture of the lot in the upper right-hand corner. 4301 Dow Rock Road is the address. And we'll get into more of the market dynamics that cause us to build here. So I mentioned that we have a very thorough report available in the deal room. But one of the things that I thought was really interesting is that according to the 22 report, Rowlett would support an additional 301 beds of assisted living alone, and a number of other memory care unit beds. So there's a massive need here, and we're not going to go and max out this need. We're not even going to come close to reaching this 301 bed need. But this is kind of the business model, which is to look for markets that need a significant number of assisted living beds and then build a number that's not even very close to it. And in doing so, we should lease up really quickly. That's been our experience so far. The average occupancy rates in the Rowlett area are 82%. And that's with older communities that are typically charging higher rents and typically have smaller unit sizes. And so 82% in assisted living is well above stabilized. The average net worth is another really important thing to know in this market. $1.2 million is the average net worth of folks who are 75 years and older. And again, this is really important because we only accept private pay at our communities. And so they have to demonstrate that they have this type of net worth before they can move in to one of our rooms. I mentioned some of these market advantages, but like if you compare where we're going to come in terms of rent, we're going to come in a little on the low side. And so we'll be the newest community on the market with relatively low rents, larger unit sizes. And we're going to be one of the few one-story communities in Rowlett, Texas. So lots of advantages to being the new kid on the block here. But we do have experience in this market. Right now, we're building in Crowley, Texas, which is outside of Dallas. That community will be done in October. And typically what we see is by the time we open these communities up, there's already 30 to 40% occupancy on the wait list to move in. Last week, I was in Merritt Island, Florida, where we built one of these communities, and construction wrapped up early this year. And when it opened up, we were already 46% occupied upon opening. So these communities fill up really quickly. We work really closely with referral sources like A Place for Mom, and we've got a really good relationship with A Place for Mom and other referral sources because Shahid owns so many of these communities.
Wow.
All right, so real quickly, I will show you some sample drone footage from the Crowley project. This is the type of footage that you'll get. Is that showing up?
I can see the slide. If it's trying to play video, it'll probably not play.
Probably not play. Okay, let's not do that then.
Okay, we can. If you have it, we can put it on a link after this or something like that.
Okay, let me get that back up again. Yeah, I will. I'll share that with you afterwards. I wasn't sure if that would show up.
No problem.
Is my screen back again?
We can see your screen.
Okay, cool. So I'll just kind of explain what you're seeing here. This is from the Crowley project. And one of the things that folks ask a lot on these construction deals, these development deals is, where are you versus budget on these? What happens if you go over budget? Things like that. And so what we're seeing, and this is in Crowley, Texas, and this is with the same builders that will be building Hampton Manor of Rowlett, is we came in about $134,000 under budget, and we're going to be done in October there. Although we do raise about $700,000 in extra funds just in case we go over budget. So plenty of extra dollars in the budget in case we do go over. And then I'm not going to click this video, but this would be like the finished product that you see in these communities. And again, I'll share both of these with you, Nick, afterwards.
Yeah, that's fine. Somebody mentioned that they could see the video, just we can't. So, but there's links. It looks like they're on YouTube.
Yeah, they're on YouTube.
Okay, cool. We could probably put them in the chat or throw it up somewhere. But yeah, no, that's great.
And here's just some sample photos. These are from one of the Michigan properties. They all roughly look the same, just with slightly different color schemes. The Florida properties have more of like a blue pastel color. The Michigan properties are typically navy blue. And I believe the Texas properties are more of like a brown and blue color palette. But, you know, a theater up here on the top left is great. We always have a spa inside. So we bring a local hairdresser and things like that in to do the ladies' hair. You know, the ballroom area always has like a piano, and there's always entertainment going on there. Down here in the lower left, we can see the eating area, and then there's also activities and things like that there. A lounge area and then a library. So these are more or less cookie cutter projects for Shahid. He's just doing the same thing over and over again, just tailoring it a little bit based on where the property is and the lot size. So like in Florida, it's not uncommon that they'll have a pool. In Michigan and in Texas, there'll definitely be putting greens and things like that.
Yeah, that's really nice having a spa in there.
Yeah, it's great. And, you know, one of the things that I really like, I go to these communities a lot and take tours with Shahid. And one of the things that I notice about him is his attention to detail. And so not only that he knows all the employees' names, all the seniors' names, he also walks around and points out all these little things that he's changed because he's been doing this for 13 years. So for instance, when he started doing this, one of the first communities he built, he put this theater in. And in the theater, he had these reclining chairs, and he realized that like the buttons to recline the chairs were very small and hard for the seniors to use. And so now he uses chairs with very big buttons to recline on it. And so he points out all these little things, little adjustments that he makes along the way. And that's one of the things that I really like about having such a thorough partner like him. For instance, this community is going to have 2 locations where physical therapists can actually come in and visit at the community. So people don't have to go out to their physical therapist to get treatment. The physical therapists come to them at these newer communities that he's building.
Very nice.
So we always have studio, 1 bedroom, 2 bedroom, and memory care suites. The studio, 1 bedroom and 2 bedrooms have kind of like a complete kitchen, just without a stove. Memory care suite, there's no full kitchen or anything like that. The people that typically move into these 2-bedroom units are like if 2 friends move in and they just want to live together. It's not uncommon that friends will choose this 2-bedroom kind of layout and
have a roommate.
What's that?
Have a roommate, basically.
Have a roommate, exactly. Just like college again. It's a little different. Okay, so earlier I mentioned that there's 301 assisted living beds needed in Rowlett. We're only going to build 60 here, and then 28 units of memory care. So you've got that continuum of care. On occasion, you'll see these communities where there's assisted living, but there's no memory care. And so the elderly will reach this point where they need additional care, but they have to leave the community that they're comfortable in. And that creates a lot of stress, not only for the person going through it, but also the family. Moving their loved ones into a memory care unit is stressful. It's not easy. And then you have to get used to all these new things. It's already a very difficult time for everybody. Here, they can just move into one of the memory care units and stay within the same community.
That's nice. And I understand that that's a relatively new, I guess, structure to these senior living facilities, because before they used to be completely separated. Different communities altogether.
That's exactly right. They would be very specialized and separated. And then they started building them where it was all kind of in the same community, but memory care would maybe be on the top story away from everybody else, which is not—
that would be difficult.
Imagine it's not a great feeling going all the way up to the top floor, and then it's kind of like locked doors and things like that. Here, you know, they're not separated the same way. It's just a nicer way to have the community laid out.
Gotcha.
So there's my partner, Shahid. He owns Hampton Manor and Build Senior Living. He's been doing this for 13 years now. We'll talk a lot about his track record and his business model here. So like I said, he's been doing this for 13 years now. His background before this was selling like medical devices to assisted living communities. And so he went into one of the communities and talked to their CFO, and he's huge on food. He's Pakistani, and I guess it's part of the Pakistani culture. And he's huge on the food. And he asked the CFO, why do you serve them this food? And he said, well, we're on a tight budget. budget. We don't have the money, the funds to really provide the types of food. And Shahid saw an opportunity to build his first community, which I'll show a picture of here in a little bit, in Bay City, Michigan. Very small, but he focused on the food, feeding people well, treating them well. And that's worked out really, really well for him. So like I said, he's in Michigan, Virginia, Florida, Texas, Illinois, and Missouri, and we'll continue building out. He's got a kind of an ambitious business plan over the next 10 years. But his business model is simple. He goes out and acquires the land. He goes out and permits it. Once he starts construction, then he brings in investor capital. Building and stabilizing it takes 24 to 28 months, at which point he refinances, like I said, and returns investor capital plus the returns. We're going through that right now in the Merritt Island property. And then he just owns it in cash flows. And like I said, his plan is to build up a very large portfolio of these and sell them off in 10 to 12 years to a REIT. And on occasion, currently, he does just sell off an individual property to a REIT or a larger company that wants to buy it. But typically, his plan is to hold.
Gotcha. We had a question come in a while back and was wondering if there would be an option to be a long-term investor in an assisted living business. I guess be a part of the cash flowing structure that Shahid has.
Yeah, so I do two types of deals with Shahid. One is obviously these construction projects, and they pay 21% return. There's no cash flow, but you get returns all at the end. The other is more of the cash flow side. So it's after construction's done. Returns are lower, but there is cash flow.
But it's income, right?
That's the income side of things. And so typically what we see there is cash flow anywhere from 12 to 16% a year with quarterly distributions. One of the things that I felt makes sense here for your IRA folks is that, you're not necessarily needing cash flow in an IRA. If you get, if let's say you're getting 12% cash flow on $100,000 investment, that's what, $3,000 a quarter. Then you have to think about how am I going to redeploy that $3,000 so it's not just sitting there. And it becomes this, and I have these same kind of conversations with family offices when I talk to them, because they run into the same problem where you send them $50,000 quarterly distribution. It's more stressful because then they have to find something to redeploy that into. In my mind, we're in kind of an interesting economic time.
Mm-hmm.
And I think we will be for a little while. If you can put something, lock it up for 2 years, roughly 2 years, and lock in a 21% return, I think that's probably better than a lot of things that you're going to find out there. But yes, there are opportunities to invest in the cash flow side of things, which I do. But I also like these construction projects.
That's great to know. Because as it is with this particular investment and just IRAs in general, people like to diversify. So you might have a slug in commercial real estate, another slug in some IPO or pre-IPO hyper growth investment. Mm-hmm. So then there's a component to income that you may be missing in your portfolio. So that could actually be a nice complement to everything that's growth oriented.
And I'm always happy if you're looking for kind of like an income type of deal. All I have to do is go to Shahid, and that's what I did. The last one I did with him was a cash flow deal, and just say, hey, I'd like to pull some funds together and buy a percentage of the cash flow from one of your properties. I mean, that's no problem.
Awesome. Yeah. Okay, great. Thanks.
So here's an example of some of the exits he had. Bay City's up there in the top left-hand corner. That's his first one. And as you can see, the construction's changed quite a bit over the years. So he used to go with this brick look, and it's evolved over time into these ones that kind of all roughly look the same. The first Bay City went so well for him that he built a second one, and then it went even better for him. All of his projects more or less look exactly the same now. It's the same kind of like roofing, the same siding, the same white windows, just different layouts according to the property size.
So real quick, when did he start doing this?
13 years ago.
13 years ago.
And the way he would build these is with his own capital and his friends and family. And as he's expanded out, he's worked with people like me who have an investor base and bring money into his projects that allow him to continue scaling.
That's awesome. I'm just thinking about the math behind starting 13 years ago versus what it would look like today. And if you were to to go forward, what I was reading is that it's currently about 500 billion, I guess, market cap, you could say. And in the next, I think it was 10 years, it could have been 5 years, I don't really remember, but it was expected to double to a trillion.
Mhm.
Could be even more by that time.
It's huge. And one of the things that I'm a little concerned about is that I talked to, so obviously I'm deep in the multifamily side of things as well, and deep into other industries. I'm focused more in on assisted living right now, like I said. I mean, specifically with this operator because he's been doing it for so long. But my fear is that I'm seeing a lot of guys who are multifamily guys, which is great.
Mm-hmm.
See the opportunity over here, jump into assisted living and just launch it to their investors. But this is a lot heavier of an operational lift than multifamily. And so I do have a level of concern that this is going to be the hot thing that people start getting into without knowing really what they're getting into.
Not taking as much care into the facilities, basically.
Not taking as much care into the facilities, not realizing that like Shahid has 700 employees.
Mm-hmm.
So, it's a full big business running assisted living. And if you're not from the space, it might look easy on the outside to just hire people to manage it. But, every time I talk to Shahid, he's driving to or from one of these communities.
Yeah.
So he's there almost every day. I'm sure he's there right now.
So he's boots on the ground, basically.
Yeah, and so, I mentioned that he's in all these different states. And so his corporate structures, he's obviously at the top with the CFO. But he's in all these different states, and he's got a team that's kind of like a miniature corporate structure in each of these states. And each of those corporate structures in each of those states then has all the hourly employees, the staff below them. So it's, like I said, it's a full on business. And I do have a concern that people are getting into the space, not realizing what all goes into it.
Right.
All right. So that's it. If this investment looks interesting to you, obviously I'm happy to talk to anybody. But the process is deciding you'd like to invest, registering for an account on the portal and letting us know how much you'd like to invest. And then we'll have the docs all pre-populated for you and sent out ready for you to sign. And that's, pretty simple investing process.
That's fantastic. Thank you very much, Ryan.
Yeah. So like I said, we talked about the brief term, the high yield, annualized return, the fact that we're partnering with a really experienced operator with a great track record in a big market outside of Dallas. And on the right here's one of the projects that is actually almost done in Wentzville, Missouri, that Shahid and I partnered on.
Nice. So you did say that there really weren't any delinquency rates because of the verification of income, right?
Yep.
Okay. I just wanted to double check that. We had a couple questions come in. So we have somebody asking about tax implication of investing in a construction project like this. So that could be a question about unrelated business income tax, or actually the financing.
Yeah.
That goes into it. So UDFI or UBIT, because there is a component that does have financing, right?
Yes, there's a construction loan here.
Okay. So would you be able to speak to what that would look like from a UBIT stance?
So there's no, and this, I believe it will be exposed to UDFI, but
Okay.
on the UBIT side, I don't know that it's exposed to any UBIT taxes. There's no like business income here per se.
Right.
So I don't think that there's any UBIT exposure, but I do expect there to be UDFI.
Probably a small bit of UDFI.
Yeah.
Okay. So that's good to know. And then somebody asked if this was 1031 eligible.
So like I said, I do 1031 exchanges, and I do exchange them into stable cash flowing ones. It's a little more challenging on these construction projects to exchange into the construction deals. But I do 1031 exchanges, and I have one that's going to be closing in August, a 1031 exchange into one of Shahid's stable cash flowing side. So this one is not a 1031 exchange eligible, but I do have a healthy pipeline of ones which are.
Gotcha. And going back to the one where we were talking about the financing part of it, if there is a portion of the amount that gets, I guess, attributed to UDFI, there would be a tax assessed to that portion of it. Everything else that would be in an IRA would be considered tax deferred, right? So if it's tax deferred, then there wouldn't be any taxes on any of those gains until you do take distribution of the assets from the IRA. And if you're in a Roth, a little bit better. If you follow the rules of the Roth, then it's potentially tax free. Couple other questions here. Is this accredited investor only?
This one is accredited investor only. On occasion, I'll set up my own fund, which invests into his properties. And in those scenarios, I do accommodate non-accredited investors. But in this one, obviously I'm presenting to a group of people here. I don't know the audience here.
Right.
I can't say that I definitely have a pre-existing relationship with all of you, maybe someday. But yes, this one is for accredited investors only.
Right. And you're easy to get a hold of. We have your contact information if anybody asks. I'm sure it's on the slides. And you also have a partners page with us. So people can jump on your partners details page and get a hold of you.
Yeah, my email address is real simple. It's just ryan@1031smart.com.
Gotcha. And you did mention there was a $50,000 minimum commitment. If somebody was able to come close but not really hit the minimum, would that be a consideration?
Yeah. So fortunately, I've got a good relationship with Shahid, and he's typically said, I don't want to accept anybody below 100K. And I worked him down to 50 and worked him down on occasion below 50. So just reach out to me and let's have a conversation about it. But I would imagine I can get you in with it. I don't want to go down
case by case basis, right? Depending. Completely understand. So do you get a K1?
There will not be a K1 generated until the end of the project.
Okay. And even if there is a K1 that's more for a taxable account. So if you do it in an IRA, there wouldn't be any K1 to report. 1099s are reported when you take a distribution of the IRA. So if you're talking about 1099 for dividends or interest, those don't even apply because there's no capital gains. There's no dividends or interest tax when you invest through an IRA. If you do it through a taxable account, then yes, there will be other tax reporting events, but not with a tax deferred, tax efficient retirement account. Let's see. We'll hold off, see if there's any other questions that come in, whether it's related to the investment or retirement. But I do, again, want to thank everybody for being here. Ryan, especially, thank you for taking the time out of the day. I know I don't know if you're on vacation or if you're just out on business in Hawaii, but definitely safe travels.
Vacation. But thanks for having me. It was great partnering with you guys, and looking forward to helping any way I can.
Absolutely. And last question, I'm going to go ahead and answer this one, and then we'll let everybody get back to their afternoon. Yes, you do get a recording of this. This will also be available on the Rocket Dollar YouTube channel. And we do have your registration information on email, so we can email you where Ryan can follow up with you, or you can just reach out to Ryan himself. But again, thank you everybody for joining. Really appreciate it. Take a look at our YouTube channel and see more opportunities like what we have here at 1031 Smart.